All right, Tim, we're on to segment number 14, profit sharing contributions. Talk to us about how we do profit sharing.
Okay, cool. So we talked about the 401k contributions because once again we have those various little sub buckets, if you will, sub accounts. Another way to get money in is through a profit sharing contribution. And that's where for sole proprietorships and for partnerships, we're allowed to put in up to 20% of the total profits of the business. So if the business had profits of $50,000, cool, I can put in 20% or $10,000 as a profit sharing contribution into the retirement plan. And where the 401ks really shine through is if I had the profits of $50,000, I can make my $19,000 401k contribution, and then I can also make my $10,000 profit sharing contribution. So I was able to move $29,000 of the profits into a retirement plan.
Yeah, and if you're over 50 again, you could add the $6,000.
Yeah, $6,000, so I'm at $35,000 off of $50,000 profits. That's pretty darn exciting stuff.
But this doesn't count for the C Corps.
No, whenever we get into corporation land, it gets even better. But wait, there's more. But it is better with the corporations. With the corporations, we're allowed to put in 25% of our salary. So once again, let's say I had a $50,000 salary from the C Corp. I throw in my $19,000 for the 401k contribution. I throw in my $6,000 catch-up contribution if I'm over 50. So now I'm at $25,000. Now 25% of $50,000, what's that, $12,500? Now I was at 25, I add in 12,500. I'm at 37,500. That's pretty darn exciting. And then, talk about the way it gets better, with the C Corporation profit sharing contributions, there's no employment taxes due. So now we're saving another 15% in taxes on that 12,500 we put in, which is another, what, 2,000 or so. So the profit sharing is really powerful with the C Corporation structure.
Okay, so what's the difference, cash or what about assets? Tell me, I mean, there's cash that you can put in, but what if you put in assets?
Well, that gets exciting too. So with the cash, no big deal. You know, we write the check from the business, and it has to be a check from the business, and we put it inside the retirement plan. But here's a little known loophole. Tax code says in certain conditions, you can contribute assets in as your profit sharing contribution. And this is really powerful where, let's say somebody has an asset that they think is just going to skyrocket.
In the future.
In the future. So now they move that into the profit sharing. Woo! It skyrockets. You sell it. How much do you have to pay taxes on that? Zero. I mean, that's the really cool thing.
So they're going to base that asset, like if you can only put in $19,000 where whatever the number is, that asset would have to be appraised or valued at that number or less. But you know, or you have an inkling of an idea or a crystal ball that says, but in the future, this thing is going to skyrocket, and all that appreciation of that value is going to grow tax-free inside your 401k.
Yeah, we've done this with a number of people. A big one is venture capital people, where they invested pennies inside of some startup company, then they put it in as their profit sharing. Takes off. Wonderful thing. People doing real estate syndications. On day one, it's just hopes and dreams. They've tied up a contract. And day two, they put it up there. It takes off. So there's all sorts of fun stuff we can do with the profit sharing contributions of assets into the retirement plan.
So is there any formal reporting or extensions? Talk to us about that.
Well, the formal reporting, no formal reporting. You're going to take the tax deduction on your tax return, whatever the entity is. That's going to show that the money was in there. Also, whenever you file your 5,500 for the retirement plan, you're going to have to show that a contribution was made. But there's nothing that you file with the IRS saying, oh, IRS, this corporation has contributed XYZ dollars profit sharing contributions. Other big thing too is the timing of these profit sharing contributions. The timing is you have until the entity files its tax return, including extensions. So like what you were talking about before with the corporation 401k contributions, you don't have to make these contributions by December 31st. You don't have to make them by April 15th. You have all the way until the furthest date that you can file that tax return. So you can take October all the way to October 15th in some cases to make these profit sharing contributions.
So what if you went past that and you're in the penalty phase? Is it still, you're still going past that?
I don't know about that. You're not supposed to ask me those questions, Mitch. I'm not quite sure what
I
would
just know
happen.
a guy that was in the penalty phase one time, and
Yeah. That's an interesting question. I think you could still probably do it, but there might be some penalties. I'm just not quite sure, to be honest with you on that one. Oh, other big thing, they have to be recurring. Whenever you set up this 401k profit sharing plan, you got to make profit sharing contributions once every other year, once every 2 years, 3 years. You can't not ever make these things. Under the strict language of the tax code, you have to have recurring profit sharing contributions. But once again,
once you start.
Once you start.
Okay. Well, you're probably going to want to anyways. Right?
Oh, yeah, because it's a great tax benefit.
Yeah, no kidding. That wraps up segment 14. We're going to move on to segment 15, which is after tax contributions.